Hey, welcome back to The Dive. Today we're chatting with Joe Mazumdar from Exploration Insights. But before we talk to Joe, don't forget to give us a follow. Hey Joe, welcome back to The Dive.
Hey, thanks for having me.
Thanks for joining us today. Okay, so one of the hottest topics out there today is Bitcoin, Dogecoin, Elon, and of course, energy consumption taking the front stage. What is your take?
I think the idea that mining Bitcoins is very high energy intensive was always known. So I'm sort of surprised that it's coming up now for Mr. Musk, considering he knows a lot about these things. I'm guessing, this is my guess, is that probably a lot of institutional investors that are weighed down by ESG compliance might have invested in Tesla with the idea that this was going to be a green company that they could invest in, and then their investment in something that's less green, like Bitcoin, might have put some people off, and it might have forced them to rethink about their investment in Bitcoin. That's just a guess on my part, but obviously that's Bitcoin has taken a bit of a hit because of that.
Okay, so let's talk gold. Do you think gold has turned the corner here?
I mean, gold's done well. I mean, it was hitting around 1700 below that range, and now it's popped back up. And I think, the issues about inflation have picked up. And if the Fed still talks about not raising interest rates while we're getting, maybe 3% plus inflation, then, the implication is that real rates might decline, and that's always been good for gold.
What do you think are the key price levels on gold?
I don't know. All I know is that producers at this level, a lot of them have reserves in at 1200, 1250. And so they're generating a lot of cash flow in their current asset portfolio. The question is right now is, using those prices, can they still add new projects? Because their tier one assets, can they find more tier one assets right now to just let them keep running to stand still, let alone grow?
Some of the large producers are now starting to generate large cash flows. How do you think they will deploy this capital?
Well, I mean, what's been happening is that over the past several years, they've built up significant debt positions, and they've been paying down their debt, which is one significant use of capital. As that's been cleared and their balance sheets look better, they've been increasing dividends to attract a different type of shareholder, because that's an easier way to compete against the ETFs. As the ETFs do not give you dividends, so. The dividend allocation is important, but then the other thing is allocating capital, not only sustaining capital, but new development capital and new projects. I see that for them to run to stand still, we'll see a little bit more being allocated into capital for development, as well as sustaining capital, just to keep the production level stable.
Do you think, from a risk reward standpoint, at this stage, the producers are more favorable?
I would say it depends on everybody's profile and their own risk tolerance, what they look at, but there's still upside in terms of valuation for the producers, given, like what you just mentioned, the cash flow that they're generating. The question is right now is how sustainable is that with respect to their project pipeline to maintain that production profile. It seems like a lot of the major producers, like your large mega companies like your Newmonts and Barricks, just having a stable production of 5.5 million ounces or so, generating significant cash flow for the dividend growth, as well as keeping the balance sheets clean, is great leverage to the gold price. The growth, really, if you want, is really in the mid tiers. They have a lower production base, and so they can show growth, and growth is something that a lot of institutional equity shareholders are looking for as well.
If you're looking at exploration companies, what are the factors you tend to favor?
Exploration, I mean, one, I'm looking at what they're looking at, how big can it be? Because I guess my end game is still for that exploration company not to develop the asset, not to put it into production, but more so get taken out by one of these mid-tiers or a larger company. So I got to see that it's got the potential to have something a suitor would want. And then does it have the size, the grade? Is it metallurgically benign? Infrastructurally, does it work? Are there other people operating in the area that would be interested in the project? Because a lot of the M&A we've seen has been incremental, like people have been buying small projects that have been close to operating mines and plants. And so that idea that they could keep feeding the plant's been an important piece of the puzzle. If you want to get an exploration company that's more of a standalone, it would have to have that size to justify that kind of expenditure to build a new plant. And so that's an important part of looking at the geology to make sure that it would have that kind of size that would entice somebody to come in.
How would you describe a property that a mid-tier gold producer might find attractive?
Yeah, like I said, I mean, if they're already operating in that jurisdiction, they could get the risk of the operating in that jurisdiction behind them. And then it's all about, is this a standalone or is this something that would have to come into my plant? And so if it's a standalone, what's the size? Can it be bigger? Metallurgically, can I deal with it? Infrastructurally, is there power or not? Is there water issues? Is there too much or not enough? All that plays into a suitor, because in the end, the suitor is not as they're not looking for a share price increase in the company that they're buying. They're more looking, is this an asset that I actually could bring in to my fold and actually produce gold from? And so, yeah, they would look at a lot of the technical risks to the asset, but just know that a lot of these companies, the mid-tier companies, need growth. And so I think right now is the time we should see more in M&A, but problematically with COVID restrictions on travel, we're not seeing a lot of due diligence, which might be holding back some of the M&A that we're looking forward to.
So when you're looking at a junior mining stock, how important is the share base? Do you typically want to see a Sprott or a Rob McEwen in the stock before looking at it?
No, I'd rather they came in after I found it. I would be more interested in the share structure to see, how many shares are outstanding, how many warrants are pending in terms of timing to get in, because looking at the fully diluted number and all those shares come in, what does the actual market cap look like then? Is it overvalued, undervalued? And then warrants would also give you an idea, or options, depending on the company, when to come in. So you could see that, oh, they've got a bunch of warrants due on July 21st. Those are going to come in, and a lot of people are very well in the money. They'll probably sell. So it might behoove me not to buy now, but wait for later. And so in terms of share structure, it's very important whether the company's overvalued or not, but also impacts timing.
Okay, Joe, so we have to sneak in a question about copper. As the price continues to hit all-time highs, we will likely see more exploration plays come public. For us new to copper, how would you begin to look at a copper exploration project?
Well, the thing is that in copper, unlike gold, there's a lot more juniors that raise money to explore for gold than they do for copper. And one of the reasons is that it's a little bit easier in terms of drilling. The cost of basically delineating a significant gold deposit is cheaper than delineating a copper deposit. So most of the exploration tends to be done by the big producers and the diversified miners with respect to copper exploration. So over the past several years, it's been harder to find juniors that hold copper assets. I'm sure in the current copper environment, the sentiment being positive, it might be easier for companies now to raise money for copper plays, but we have to know that the expenditures required to delineate a copper project might be a lot higher than with gold, and it's not for everybody. Because copper is logistically, it's a commodity where you don't usually produce the end product, a cathode. You tend to produce a concentrate. So logistics, infrastructure, a lot of that matter even more for a copper project than it does for a gold project.
Okay, so last question here. For our audience who wants to learn more from your research, where can they go to?
So Exploration Insights, which is a weekly publication that I put out every week, is based on what I'm buying and selling in the mining sector, and a lot of rants about what we're seeing. Recently, I did a piece on financing, and then just this last publication on Sunday, I talked about the Peruvian elections. My background is exploration geology, mostly in places like Australia, South America, and then corporate development and market analysis in the States for companies like Phelps Dodge, which is now Freeport, and Newmont. And then I did 6 years as a brokerage analyst before I took over Exploration Insights from Brent Cook. So again, you go to explorationinsights.com, and we've got some free stuff on the website, but also if you want to subscribe, you just press subscribe now, and it's a monthly fee, and you can cancel whenever you want if you like this stuff.
Perfect. All right. Well, thank you so much for joining us today and giving us some of your insights, Joe.
Great. Thank you. Very much appreciated.
Thanks so much for watching, and tap that notification bell before you leave.